At IB Canada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
Hey guys, Glen of the IB Canada Group here today, and I wanted to talk to you about financing. Specifically, the topic, we finance everything we buy. That sounds a little strange, right? You may say, you know what? I don't finance anything. I save my money up and then I purchase what I want so I don't pay anyone financing. Well, you know what? That's a good way to do things, but not necessarily the best way. But here's the thing, you are still financing it. And let me explain why. According to R. Nelson Nash, who is the founder of the infinite banking concept, on page 85 of his book, he addresses this by saying we're either giving up the chance to earn interest on our money or we're paying someone else interest. For one way or another, we finance everything we buy, no exceptions. How we think about things is not always the way things are. The wealthy know a secret that most of us don't seem to, and that's using other people's money. Now, what do I mean by that? I'm going to show you in the example here. Let's start with this. I've got $40,000 saved up, and I'm thinking I'm going to go buy a car, right? I look around, I find a car that, wouldn't you know it, it's $40,000. Now I'm getting 4% on my money, and I'm looking at the car, and the guys at the dealership say, hey, you know what? We've got a great rate for you today. We can get you a car at 6%. Now, conventional wisdom says that's kind of ludicrous. Why would I pay an extra 50% in interest, right? 6% from 4% to get this car? Why not just cash out my money, save myself some interest, buy the car cash, and away we go? But is that really how it works? What is it that rich people seem to know intuitively that most of us really don't get, right? Or we just haven't thought about it the right way yet? Well, it's that using other people's money just makes sense in some cases. So let's look at the math. So if I've got my money here at 40,000, 4% compounding interest, I'm expected to earn 8,840 over the next 5 years. And before you say, where are you going to get 4%? It can be done. It is there, but that's another video. Now, here's the difference. I'm getting compounding interest. If I go borrow this money at 6%, yes, it's amortized interest. And the difference is each payment I make lowers the amount I owe. So even though the interest rate is higher, the volume of interest is lower, which is what leads to me making a total payout of $6,399, while my money was $8,840. So by financing the car at 6% and leaving mine at 4%, I end up with an extra $2,441, which incidentally is 38% without taking on any risk. So it's accumulated 30%, it's about 6.5% a year. Think about that. What if this were a house? What if we added an extra zero? Just think about the difference in interest. What if I'm buying another 5 to 7 cars over my lifetime? If I never interrupt the flow of my interest and I finance in a situation like this where it's advantageous, okay, how much further ahead do I get? Rethink your thinking, because at the end of the day, we do finance everything we buy. So let's make sure you're doing it to your own advantage. Glen Griffiths of the IB Canada Group. Look forward to talking to you soon.
IB Canada Group, your independent authority for information on the infinite banking concept.